I will tell you what I think is really interesting here, from my perspective, is in everyone's opinion, I'm a complete idiot.
So, Corey, you're not dabbling in crypto. You're diving into the deep end.
One for the money, two for the show, three to make ready, and four to go. Bon voyage. Uh-oh. Forgot to fill the tank with water.
So look, I don't have any strongly held views about crypto. I think it's really fascinating and interesting, but I haven't spent enough time looking into it to even understand some of the stuff that's going on. So let's get that all right. But what I do know is that when you can buy a Bitcoin and then sell a futures contract for delivery of that Bitcoin 1 or 2 months out, and the premium there is 15 to 30% annualized, that looks pretty attractive to me. And so that's where I'm dabbling.
And in that sense, though, it's not really a crypto trade, right? It's a basis trade or an arbitrage trade.
Yeah, so this is traditionally would be called a cash and carry trade, where I'm basically long the Bitcoin, I sell the futures exposure, which basically says I have to deliver the Bitcoin, or depending on the exchange, it's cash settled, but to a price very similar to the Bitcoin. And I'm effectively what would be called delta neutral. So if market goes up, market goes down, my long position is offset by my short position. And unless the spread between them goes wider, I'm effectively waiting for that spread to converge and earning that spread that I locked in.
Yeah, and so as we said, those are like kind of the simpler ways of thinking about the trade, but obviously the trade has become much more nuanced as you dove into this. And so maybe we could start with, a simplified CME version may be helpful, and then maybe we could talk about the other exchanges in crypto land.
So what's interesting is the CME, which now has Bitcoin futures that are listed, is actually the more difficult version and potentially the less attractive version of this trade. At least prior to this week, when you didn't have micro Bitcoin futures trading, one futures contract was equal to 5 Bitcoin, and you had to fully cash collateralize that exposure. And so because it uses twice the initial capital, it effectively cuts the return in half. When you start to look at this trade on offshore exchanges, you actually don't need to put up all that cash collateral. In fact, what makes these exchanges so attractive to a large number of participants is the fact that you can have a huge amount of leverage.
And those exchanges, actually, the premium is higher than it is at the CME. And did you think that's part of that is maybe the platform risk of using an exchange that's, not people are accustomed to the CME, and CME has cross collateralization, institutional players. So is that the difference primarily in that spread, is maybe the platform risk?
I think there's probably 3 differences. The first would be definitely the platform risk, right? The idea that if I'm going to put this trade on, sort of the number one big headline risk is the platform gets hacked, or the platform isn't able to manage collateral appropriately. I would also argue that these exchanges are catering to less institutional players. You're getting far more retail activity who in the current market seem to want to be long and strong. And so there's a ton of retail demand for leverage. One of the things I've heard over and over about this trade from a lot of people is, look, if you've got $5,000 that you're putting into crypto, you're not trying to earn 15 to 30%. You're trying to earn 1,000%. And you're not going to earn 1,000% with a cash and carry trade. You're going to earn 1,000% by taking a levered altcoin position. I will tell you what I think is really interesting here, from my perspective, is in everyone's opinion, I'm a complete idiot. So I have people from traditional finance telling me, why in the world would you dabble in this trade? There's huge systemic risk. Yeah, you can diversify across exchanges and across different coins, but man, if Bitcoin goes down, all these exchanges are blowing up and you're going to lose everything on all these exchanges, right? And then I have the people in the crypto space going, isn't that quaint? That your cute little 20 to 30% return, if you knew what you were doing, you could get a 60% annualized return. Or the opportunity cost of your capital, wouldn't it be better in some of these altcoins where you could make 1,000% returns? And so both sides are sort of telling me I'm really dumb for this trade, which probably explains why the trade is still there. But I think it's very interesting to see both sides. Before we get into the trade, I want to stress that none of this is investment advice. It's purely for entertainment purposes only, mostly at my expense. You should do your own due diligence, seek investment professional advice, and never ever invest more than you can afford to lose. So I'm going to place this trade on the Kraken exchange, and the first thing I actually have to do for this trade is buy some Bitcoin. And once this is done, the clock starts ticking because we've only executed one leg of the trade. We still need to short the futures contract. But to do that on Kraken, we first have to move our Bitcoin to our wallet on their futures platform. Once that's done, we actually need to take one more step within the futures platform and move our Bitcoin from our holding wallet to our futures wallet, where it can be used as collateral. Once transferred, we can now short the corresponding futures position. On Kraken, the contracts are actually inverse futures, so they're quoted in dollar exposure. We want to match the amount of Bitcoin we have, which is approximately $7,500. Later, we can go to our trade logs and see the funding rate changes that have accrued to our position. These logs are actually from trades I placed earlier. If we were to do this trade on an exchange like FTX, we would see similar funding payments, but paid out hourly. Note that the payments are negative when the short position, our position, earns the funding rate. But we can also see that there are times where we were actually a payer. I have no idea where I was going with that. All right, Jason, the trade is on. And someone wise once said to me that the most unbiased point is the moment right before you put the trade on. And then after that, you are completely biased. So I can no longer answer questions about this trade. So I'm going to flip it on you. Where are my risks? What am I missing?
Yeah, right now you're rooting for the home team. You want Corey's trade to work out. So, I think there's several risks we've illuminated is the idea of just getting your money on and off the exchange, right? And that's the difficulty. Like the worst risk is this isn't wildly successful for you. You put a bunch of money into the trade, you're making incredible returns, and then you can only get out a few $1,000s a day. So you're basically stuck in limbo for the next 6 to 9 months. That's, a known risk, but a terrible risk. And there may be some ways around that if you get an institutional client like certification on that side. The other one to think about is, platform risk. That's what everybody is concerned about. And I actually think that's where a lot of the premium comes from, is just institutions are afraid of platform risk. But I think that's a latency effect from, 2017 or prior. I think that when you're talking about exchanges that you're looking at, whether it's Kraken or FTX, you don't have that kind of platform risk that you had, prior to 2017.
This isn't Mount Gox anymore.
Yeah. It's, a lot less fly-by-night. They're still out there, but I think you're looking at like legitimate providers, especially if they have KYC laws right there, that at least you're dealing with somebody with a little bit higher standards. But there's always going to be at least a slight platform risk at the end of the day. The other issue is obviously on the trade perspective is if the trade goes against you. What happens when that spread widens or contracts? You have to monitor that, especially when you're dealing with the perpetual side. You got to kind of be on top of that. And I wonder, crypto's a 24/7 market. So Corey may be losing some sleep here, monitoring these positions. Like, what are you going to do when you're asleep if that trade blows out against you? So those are just some of the ideas. I'm curious of how you've thought through those.
So I think the ebb and the flow of these premiums and these funding rates are both a risk and an opportunity potentially. With the perpetuals, right, where that funding rate is resetting every hour or every 4 to 8 hours, it is something you have to be aware of. I do think over the long term, though, that funding rate and the futures premium are going to be somewhat related. right? If they get too distorted, if the funding rate turns negative, but the futures premium is still positive, there's a trade there that you would expect them to converge back. So I think as long as you're keeping your eye on the futures premium, and as long as that's significantly positive, you can probably sleep pretty well knowing that the funding rate is going to be, on average, pretty positive on your perpetuals. That said, there's nothing stopping me from putting on this trade today and having all the premiums collapse and enter a crypto winter that this trade then becomes unattractive and I have to unwind everything and take it all off the exchange. There's certainly a timing element here to what's going on. That timing element is accentuated in the perpetuals, at least with the fixed maturity futures trade. You're locking in that fixed return. The other element, though, especially on the fixed futures side and somewhat on the perpetual side, is, you know, we talk about putting this trade on and waiting for convergence at maturity, but you can see convergence much earlier than maturity. So you might be able to say, all right, I'm going to get that premium to collapse. I'm going to sell out, sit on the sidelines, and then the premium widens again and you put the trade on. And instead of getting a 10, 15, 20% annualized, you can now get it to 30, 40% annualized just based on that opportunistic trading. And so you definitely want to keep your eye on this. I've actually written some tools that can scrape the APIs of these services to automatically check the premiums, but there's websites like ftxpremium.com that updates these almost every second, and you can look at what the funding rates are for all the perpetuals and what the premiums are embedded and what the lending costs are and a lot of the stable coins.
I remember back in the day when I was looking at, I was playing around with BitMEX to learn kind of like how these perpetual futures work, and in the inverse ones as well. And even without, I remember without even using much leverage, sometimes I wake up in the morning, the positions are closed out on me and you're just like, what the hell happened? And I had to go figure out like what's going on and try to figure that out over time. And so I know you're not, you know, leveraging up these positions, but correct me if I'm wrong. There was some point where FTX, there was a barrier where they would close out the trade on you. Is that correct?
Yeah, you have to be a little careful with some of these trades. So you have to go through the exchanges and look at their liquidation rules, how much margin you have to keep around. Ideally, you are keeping these trades one-to-one when you're putting them on, though for security reasons, you might actually do this in a levered fashion where you keep some of that actual long underlying exposure off exchange, and you might do this trade 2-to-1 or 3-to-1 on the exchange. But that's really unlikely to get you liquidated unless you're playing with, you know, coins that can jump 50 to 100% in a day. If you're sticking with Bitcoin and Ethereum, where you're unlikely to see that as much, it's less risky. But something like FTX does have a fixed dollar number at which they will start liquidating your coin collateral. And for them, it's $30,000 per sub account, where on something like Kraken, if I did this trade 1-for-1, there's really no price at which I can be liquidated. So Jason, you've looked into all this stuff before. And by the way, every time I ask you about a weird esoteric investment, it's like you've looked into it years prior. Why haven't you done this?
I think, like we talked about before, you and I've had a lot of these private discussions about a lot of the way we think about markets or think about life can be due to prior experience, right? And so I wonder how much of my thinking is pre-2017 and the platform risks. So I maybe have too much burden of platform risk in my mind, and I'm not attenuated to how things have changed. I also look at, I think it's interesting, like apps like Alpha Homora with their 3-pool trades and everything. I think you can get where they're algorithmically programming these kind of trades for you using liquidity pools, but also they're algorithmically programming almost like your leverage cascades, as well as your compounding on the timing windows. So you can like they have, I mean, it's ridiculous returns of like 100 to 200% annualized returns. But I think it begs an interesting question about position sizing, right? If I'm afraid of if I'm afraid of the platform risk at like an FTX or Kraken, which I probably shouldn't be, but I can get 20 to 30% returns. But at Alpha Homora, I can get 100 to 200% returns. I can use a much lower position size if I view the risks are commensurate with each. So then I position size my risk appropriately. Now, I haven't done it yet. I have friends that do it. but all of it makes me a little nervous. I think at the end of the day, a lot of the DeFi premium is because people like you and I are very nervous, and it might be for very good reasons.
I think the real question that I have about this whole situation, Jason, is when am I going to be the one that stops doing the goof trades and we actually put some of your money on the line?
That's too enjoyable for me. Now make sure you like, subscribe, and hit that notification bell so you never miss one of these amazing episodes.